Okay, now the same sum, if I have to do using cash flow function. Then go to BA2 plus. Okay, so Shravani, you listen. Okay, here,
Yes, sir.
cash flow function. So these all are cash flow. You are going to get 1.744, 1.90, 2.072, 2.5. No, this one is 31.608. So right now it is zero amount because we are not going to consider this one. Okay, based on all the expected cash, we are finding the present.
This we won't feed in 1.60 in CF0,
No, we will not feed in
right?
because based on all the expected value only we are finding the present value. 1.60 is not
Okay.
the expected value. So
Okay.
so I will so how to do this is, all these are different amount, right? When all the payments are all different, I will use cash flow function. This is the one cash flow function. So you can also simultaneously do along with me. Okay, so cash flow. So first I'll convert this into 8 decimal. Now cash flow. Once you go into the function, just do second clear work to clear any previous memories. Okay, so again go to cash flow. Now first, initially it is zero. Currently right now you are not spending any money or not receiving any money also. Okay, right now, so it is zero because based on all the expectations we are calculating. So 0, enter. Okay, and then downward arrow. Done till here?
Yes, sir.
0, enter, downward arrow. C0, and that means cash flow at time 1. Time 1 is 1.744. So 1.744, enter. Okay, 1.744. Then downward arrow. Then frequency 01, you ignore it now. I will tell you when it is required. Otherwise, you have to ignore only all the time. Okay. Rarely we will be using that. When such case comes, I will tell you. So frequency you ignore. Then again you do downward arrow. C02. That means cash flow at time 2 is 1.90. So 1.90. Enter. And then downward arrow. Frequency again you ignore it. Again downward arrow, come to C03. Is it done till here?
Yes, sir.
So C03 is 2.072. So 2.072. Enter. Okay. Then downward arrow. Frequency again, ignore it. Then C04 is 31.608. 31.608. Enter. Till here done.
Yes.
Then click on NPV, net present value. We want to calculate what is the present value. So net present value. Now when we calculate net present value, it will ask for, what is the discounting interest rate. So discounting interest rate is 12%. So don't put percentage, just put 12, because the system knows that it is percentage because it is interest. Enter.
24 point.
Okay. Yeah. And then you do downward arrow. You will get NPV 0.
Compute.
Then you click on compute. 24.63.
Yeah.
Yes, sir. Got it.
Got it? Okay. So later on you practice this. Okay. This we will be using many times in corporate issuer subject. Okay.
Okay.
So when these payments are all different like this, Okay, and all has to be discounted with only one rate. That time we can use cash flow function, or manually also you can do. Okay.
Okay, sir.
Uh,
20th one, sir.
mm,
The best model. to-
20th one.
Yes, sir.
The best model to use when valuing a young dividend paying company that is just entering the growth phase is most likely the best model to use when valuing a young dividend paying company. Young, okay. Dividend discount model should be used for matured company. But okay, they said 2 stage and 3 stage. That is just entering the growth phase. See, Gordon growth should be used for maturing
Yeah,
constant growth
like,
company, constant
yeah,
growth. So
constant.
because it is young, and if I have to select one out of these three, then I'll go for 3 stage.
Okay. Like, what's the, like,
Just
what is
entering
two
the
stage
growth
and three
phase.
stage?
That means the one that we did before, that is a 2 stage growth, because it
This
is
one,
growing at 9%,
and
and
then
then it is
4%.
constantly growing at 4%. So this
Okay.
is 2 stage. 3 stage means, let's say it is for 4 years, it is growing at 9. After that, it is growing at 7% for 2 years,
Yeah.
and then it is coming to constant
Okay.
4%. Then it will be called as 3 stage.
Okay.
So
So
this is
for
three
more
stage.
stable companies, we'll use Gordon
Gordon
growth
growth, yeah,
model,
yeah, yeah.
and then we'll use two stage, and then for new companies, it's three stage.
Yes, yes.
Okay. So what we
So
did wasn't Gordon growth
Gordon
model,
growth
right?
only, but Gordon
But
growth is
two
also
stage.
included, but 2 stage. So
Okay.
Gordon, where only Gordon growth will become 1 stage then. Only one growth, consistent growth.
Right. Yeah.
Next one.
It's 22nd.
22nd. A price to earning ratio that is derived from the Gordon growth model is inversely referred to the growth rate, dividend payout ratio, and required rate of return. Price to earning ratio that is derived from the Gordon growth model. Okay, is inversely Asha. So derived from the Gordon growth model means this is P0 is equal to D1 by R minus G. Okay, now
Yes.
price to earning derived from Gordon growth model means, now this is, imagine this is trailing PE ratio, price to earning. So when I will divide by, E0, so overall it will become D1 by R minus G, and this I can write like this here. Okay.
Yes.
So now further I can, so this is one formula, right? Now I can further, now the question is growth rate, dividend payout, and required rate of return. Okay, let me further rewrite this as growth rate, they said, no? Okay, see, first of all, growth rate. If growth rate is increasing, what will happen? This R minus G will decrease. If that is decreasing, then overall answer will increase.
Right.
Okay, is inversely related. That means if growth rate is increasing, overall P ratio is also increasing.
Yes.
But they said inversely related. So that's why it will not come. Is it okay?
Yeah.
Then next one, dividend payout ratio. Okay. So this I can further rewrite as into 1 plus growth. So this becomes dividend payout ratio. Okay.
So what is that 1 plus G?
This I have not taught to you, is it? No, I think I
No, you
taught.
did this formula, but
Yeah.
right.
Okay. 1 plus G is, see, this is D0, D1.
Okay, D1. Yeah,
D1 I am
got it.
writing as
Got
D0
it now.
into 1 plus G.
1 plus G. Yeah.
Okay, and D0 by E0 I am writing as DPR, dividend payout ratio.
Yeah, it is the
Okay.
formula of DPR, right? D0.
So now, where is that question? What is that question number? 20, right?
22nd. Yeah, 22. Yeah,
So dividend payout ratio, if it is going up, then overall P ratio will go up because that is the numerator. So that also is not inversely related, it is directly related. Then required rate of return, inversely related to the required rate of return. Required rate of return is, if required rate of return goes up, then overall this number will become bigger. If this number is become bigger, entirely this number P ratio will become smaller.
yeah.
So that is correct, inversely related. No? If R is
Okay.
going up, P is coming down.
Yeah, right.
Okay.
Got it. The 23rd, next one.
The primary difference between P multiple based on comparable and P multiple based on fundamental. So this, okay. Is that the fundamental based P's takes into account it can take into account future expectations also. Future expectations. Because I can also find out P ratio using this way also, correct? E1, dividing E1 both the sides. So future expectations, P ratio.
What is fundamental P? It is like, uh,
Fundamental means all these are fundamentals, right?
yeah.
I'm not directly, uh, finding. Okay, fundamental P ratio and comparable P ratio. See, comparable is directly just price and earnings you are taking, nothing else. Price and earning. And fundamental, you are calculating all this based on all these expectations. Okay, all these all these variables you are considering to
Hmm.
calculate P ratio. So all these are fundamentals, right, of a company.
Yeah.
what is the next one?
Yes. $27.
Current price, last year's EPS, current year's estimated EPS. Which of the following statement is most accurate? Delta has the higher trailing PE multiple and lower current estimated PE multiple. Alpha has the higher trailing PE multiple and lower current estimated PE multiple. Alpha has the higher trailing PE multiple and higher current estimated PE multiple. Current price, last year's earning per share and current year's estimated. Delta is this company, has higher trailing PE multiple and lower current estimated PE. Alpha has higher trailing PE and lower current estimated PE. Alpha is, so we have to calculate trailing PE and estimated PE for both. Then only we can compare. So this is price. Okay, it's a direct comparison only. So for alpha, trailing PE, this is trailing. $3.82. Calculate how much is this?
15.0052.
And leading means estimated.
Estimated. So that will be.
So price is the same.
Yeah, it's 12.0673.
Yeah, earning is 4.75.
Current year's estimate.
12.0673.
73.
Okay.
Yes. And for
Then
delta, right?
delta. Now trailing.
Trailing is like the current year, right?
Yeah.
And so like, but they've said current year's estimated EPS. So like it's the futures, and let's say five after
Last
4
year's
months.
estimated and current year's. Current year's estimated means future, right?
Future,
Future
yeah.
estimated. The last year's estimate is over E0. This is so 18.93
0.93 divided
divided by E0.
by
Last year is
14.0222.
1.35.
Yeah.
14.0222.
Yeah.
And leading PE.
It's 13.5214. Yeah.
E1 is 1.40. Now you just have to cross check with the answer. Delta has a higher trailing P multiple, and so delta has higher trailing multiple
Yeah.
and lower current estimated P multiple.
Yeah.
Lower estimated P multiple. Okay. Then delta has higher trailing P multiple. Alpha has higher trailing P multiple and lower current estimated P multiple. This is also correct only then. Alpha has higher trailing P multiple. Alpha and higher current estimated P multiple.
So it won't be C.
Current estimated P. It will not be C. So between A and B.
So they've said delta is the higher trailing. So that's wrong, right? It's B. It's not
Delta has
alpha.
higher trailing.
Yeah, so it's wrong.
Delta
Alpha
has
is a,
higher trailing.
so is it lower the better or the higher?
No, it is not like lower or higher.
So then it's B, right? So they've said delta, not alpha. And the first one it's
I'll
delta.
see delta has higher trailing
Yeah,
P
so but
multiple.
alpha has it, right? You have mistaken alpha
Okay,
is
okay, we
delta.
have to compare trailing P multiple delta with alpha. Okay.
Yeah, so A
So
is wrong,
between
right?
these two, when we compare, this is A is not correct. Then alpha is higher trailing multiple and lower current estimate.
Yeah,
This is having higher trailing multiple when we compare. And yeah, when we compare these two, this is having lower.
yeah.
Yeah, so it
B is
is
the
it is
answer.
B. Yeah, yeah, right.
And then just a minute. 30th one. 30.
Which are the following statements regarding the calculations of the enterprise value multiple is mostly correct? Which of the following statements regarding the calculation of the enterprise value multiple is mostly correct? Operating income may be used instead of EBITDA. EBITDA may not be used if the earnings are negative. Yeah, if earnings are negative, earnings
So won't it be C, sir? Like book value of
book
debt
value
may be
of debt
used.
may be used instead of market value of debt. No, market value we should use only if it is not available. Then we should go for book value.
Okay, so and
So
they have said
C is right.
instead of market value.
They have
That's
not
why
said. They just said book value may be used instead of market value.
instead
No,
of
but
okay.
market value only you should use. Only if it is not available, then we should go for book value.
So what is the answer? The A?
No, C is not the answer.
Okay.
Okay, now EBIT operating income may be used instead of EBITDA. Again, the most accurate one is EBITDA may not be used if the company earnings are negative. If it is a negative, you cannot use only EBITDA.
Okay.
So it should be B.
And can you explain A point A, the
Operating
operating
income may be used. Operating income is EBIT they are speaking.
EBIT?
EBIT instead of EBITDA. So EBITDA is more accurate one. Why? Because you don't want to go for depreciations, all those, when
Okay.
you are acquiring a company. You want to know basically how much it is earning before interest, tax, and depreciation.
Okay. And like from EBIT, depreciation is already deducted, right?
Then yeah, debit.
When
Yeah,
we
yeah,
derive at
yeah,
all.
yeah, yeah.
Just check them. So it's A
Operating income may be used. Okay,
in place of EBITDA when calculating the enterprise value.
13.
Yeah.
30. Okay, let me see. Operating income may be used in place of EBITDA when calculating the enterprise. EBITDA may be used when company earnings are negative because EBITDA is usually positive. What does this mean? EBITDA may be used when company earnings are negative because EBITDA is usually positive. That means
EBITDA may not be used. And EBITDA company earnings are negative. So like, is it a printing machine?
when company because EBITDA is usually positive. Okay, let's
So
just
like even when it is negative, we should use it.
yeah because
So they're
EBITDA is
saying,
positive. No, that is not making sense, no? Because EBITDA is negative.
so they said
Um,
EBITDA may be used when company earnings are negative because EBITDA is usually positive. So they are trying to say that like even when EBITDA is
EBITDA
negative, we
is
can use it.
no. They are saying even when net income is negative, we can use
Yeah,
EBITDA.
EBITDA.
But that
Yeah.
was not the question, right? The question is EBITDA may not be used Acha, if the
Yeah,
company
most
earnings
likely
are
correct.
negative. Okay, Acha, no. Then it is
No,
our
then
mistake. See, earning means net income.
okay.
If net incomes are negative, still you can use EBITDA. Okay.
But then they've said is most likely correct. Then they should have written EBITDA may be used if company earnings are negative, right?
No, they have mentioned answer as A, right?
Okay, yeah.
Yeah,
So,
A. So this is wrong then.
okay,
EBITDA may be used even if the company's net income is negative.
okay, okay. E is the answer.
So in that case, then out of these three, obviously EBITDA is the preferred one. But if it is not available, then out of these three we can go for EBIT.
So most
Because
likely
here it
correct is
says
operating income.
EBITDA may not be used. Then you cannot do that one. That is wrong. Here
Okay.
also is wrong. So here at least only depreciation is missing. You
Yeah.
can use then EBIT. Shravani, you understood this one?
Yes, sir.
Okay. Okay. What is the
33. This is the last one.
The disadvantage of the EV method for valuing equity is that the following information may be difficult to obtain. Market value of debt is difficult to obtain. Okay. But rest all are fine, right? Market
Like,
value of
won't
debt.
it be a market value of equity?
No, that is just share price in the market
Okay.
into
So
number
I
of
thought like
shares.
everyone have different expectations. Yeah.
Now, whatever be the share price in the market,
Hmm.
that is market capitalization only into number of shares will give you
Yeah.
market value.
Market value of it. Can you explain? Like, can you elaborate on this? Like,
Okay.
point B.
See, what is the formula for EV? Enterprise value multiple is equal to enterprise value multiple is equal to uh, market value of equity plus market value of debt
Yeah.
plus market value of preferred stock
Preference.
minus cash and marketable securities.
Right.
So market value of debt is difficult to get,
Okay.
divided by EBITDA. This is the formula.
So, but
So
we'll have all the
this is
all
considered as enterprise value.
like we'll have all of the items on the balance sheet, right? As in,
Huh?
uh,
No, balance sheet will have only book value of debt,
okay.
not the market value of debt. So if it is not listed, that's why then we will go for book value. That's why market value is little difficult. Also, most of the time debts are illiquid.
Hmm. Done, sir. No more questions. Yeah.
Okay, that's it. Shravani, what are your doubts?
No, sir, it were covered in this.
Okay, fine. So no more questions, right? Okay. Okay, then we will stop now. Then we'll continue with derivatives next time then. Okay.
Yes, sir.
Yeah.
Tomorrow.
Yeah, tomorrow then.
Okay. Thank you, sir.
Okay.
Bye.